Liquidity is so important. It is never there when you need it.
You're running your overlay on $8 billion. How do you think about your portfolio? How do you make your decisions?
In general, those quantitative models take about 75% of the weight in terms of the decision, and then the 25% goes to qualitative assessment. I'm very risk averse. I think the geopolitical risk is transitory. The long-term fundamental factors, earnings power, profitability, PE ratio, those are the ultimate factor that will decide where the market will go.
What do you think is the biggest misconception that people have about overlays in general?
All the asset managers and hedge funds, they are doing something. Not doing something is also an active bet.
Hello and welcome to Capital Horizons, the podcast where investment matters. I'm Igor Yelnik. My guest today is Joy Xu, Senior Investment Director and Advisory Board Member of Verizon Investment Management. Hello, Joy. Thank you very much for joining me.
Hi, thank you for inviting me, Igor.
So can you explain us, what do you do for Verizon?
Oh, I'm currently a Senior Investment Director for Verizon Investment Management Corp. We manage the DB plan, DC plan, Aviva plan, and a foundation. And my role here is multiple. I manage the strategic asset allocation for all the funds. I run a tactical overlay portfolio for the pension fund, head of the risk management, and also have a role to implement strategies through hiring and monitoring or firing external managers as well.
Okay, so you do quite a lot there. Do you report to the board?
Yes, I do. We quarterly updated the board on the capital market development, the fund performance, and any risk we see in the foreseeable future.
Okay, and how big is the mandate? How big is the fund?
The fund total assets is around $50 billion.
Okay, and you're running your overlay on this $50 billion?
No, I'm running the overlay on $8 billion, the pension fund only.
I see. Okay, so can you explain us about how this mandate is defined? What does this overlay do?
Yeah,
Why do you need it at all?
the GTAA overlay portfolio developed out of the need to for the benefit payment. We have a pretty high benefit payout ratio. Each month we have a cash raising meeting. In those meetings, we have to decide where we raise the cash from and how we are going to rebalance the portfolio. Over time, we wanted to have a more disciplined way, a data-driven approach with macro awareness. That's how we developed it. And we want to use this as a guide for us to raise the cash and rebalance the portfolio and risk manage the portfolio as well.
Okay, that's very clear. And we'll explain to our listeners and spectators that GTAA stands for Global Tactical Asset Allocation. Now explain what it is.
Basically, it is a looking at the global market, using data-driven approach, decide where you want to take a tilt versus your strategic asset allocation. The reason for that is, as we know, majority of the funds or money pools are managed based on strategic asset allocation. You have a risk return target, and you base on the long-term capital market assumptions, which assume the market is in equilibrium, and you develop a long-term static strategic asset allocation. You hope over time, through this disciplined investment, you will reach your investment goal within the risk parameters that you set for yourself. However, over time, we always found ourselves in a situation that the market is not in equilibrium at all. It moves around and dislocate from this equilibrium, sometimes by 3 to 5 standard deviation. That's why our team were thinking that, we need to use the prevailing market condition to adjust instead of just going naively to strategic asset allocation. That's how the GTAA is used. It's used for tactically position the portfolio given the prevailing market conditions to take advantage of the dislocation and also help the portfolio to be more stable over time.
And you do it using futures?
Yeah, mostly futures. Yeah.
Okay,
and swaps, some swaps.
Yeah, and I presume you trade globally, right? It's not only the US.
We trade the exposure is global market. Yes.
Okay, great. What's the difference between your mandate and a similar portfolio which would be run, let's say, as a hedge fund?
Okay. I think there are some similarity and the difference as well. In terms of this particular mandate, it's have the awareness of the strategic asset allocation of the fund and also the exposure, the current exposure of the funds. So it complement the existing exposures that the fund normally gain through physical managers. However, the similarity is that this program can definitely view as a standalone because the program generate long and short signals and implement it through futures. It can definitely compare to the standalone portfolio. I actually take a look at the performance and compared it also to the hedge fund index as well from time to time.
Okay, yeah, it makes sense because it's an overlay on $8 billion, which is quite impressive. And I presume the tracking error is probably somewhere around 0.5%, right?
Yeah, the over the past 12 years, the tracking error, the risk of the overall overlay portfolio is 48 basis points, and with annualized alpha of 65 basis points.
That's very impressive. That's the information ratio of around 1.2 over such a long period of time. With a tracking error of 0.5%, $8 billion, this is an equivalent of managing a hedge fund with $400 million at 10% risk, at 10% volatility, which is quite a decent hedge fund. You won't compete with millenniums of the world, but nevertheless, it's very decent, and the results are very impressive.
Thank
you. So explain us, how do you reach those amazing results? How do you trade it? How do you think about your portfolio? How do you make your decisions?
Okay, so Igor, basically there are two parts of it. Majority of the part is running a quantitative data-driven models. So those models are based on 4 themes. The first one is fundamental and valuation. Basically, we look at the valuations of one assets and compare where it is in its history, and also compare this assets versus other risky assets at a similar risk level, I would say, and also compare that with cash. So we have this relative approach as well. The second theme is the technical factor, basically focus on market momentum and volatility regime. And then third is we look at the sentimentals. So we measure the participant sentiments alongside with real-time economic activities. Finally, we focus on liquidity and risk. We analyze different type of term structures and liquidity premium. So based on those factor models, they aggregated at an asset class level, and then it give me a plus minus direction, which is long and short, and also give me a plus minus 5 or a range of 5, how aggressive the model want to be. So with those model recommendations, I do not translate that one-on-one. I also go through some qualitative assessment. So those qualitative assessments include we using macroeconomic factors to determine where we are in the 4 phase of macroeconomic cycles. And then, as you and I, we all know that macroeconomic cycles are not coincide with capital market cycles. So we use some indicators to help us to identify where we are in those 4 phases of capital market cycles. Finally, we also pay attention to credit cycle and monetary policy as well as fiscal policy to give us an overall risk assessment. With this, and then I come back to look at the model signals and assess the overall risk I want to take. And then from there, I will size the relative trading size for one asset versus the other. In general, those quantitative models will take about 75% of the weight in terms of the decision, and then the 25% will goes to qualitative assessment. That's in a nutshell.
Okay, interesting. Can we consider some examples? Let's consider the period of 21-22.
Actually, 22, in normal times, the model signal will take the majority of will determine the trade size. And I will give you an example of 2020 when the COVID hit. And before February 20, around time of February 2020, I think the model already indicated a pretty flat risk taking. And then in March, when we see the whole world shut down, and there was not, I couldn't see a recent history that the global economic shut down. And then at the time, the market went down, and then the model signal become very negative. And then we look at those models, we decided to implement at full force because the risk we saw is very significant in the foreseeable future before the central bank come back to cut risk. So we decided to take the full risk at that moment. And another example would be most recently in March. So the model signals generated using the end of month February data was risk on. And then as we know that the market has been performed well, the expectations for earnings growth has been pretty strong, especially for the U.S. in January and February this month. And the market has been pretty performed pretty in line with the expectations. And at the end of February, the model has a pretty good risk-on position. And then over the weekend, the military action happened in Iran. And in the first week of March, given this geopolitical uncertainty, we did not implement the model recommendation. We kind of want to hold the position closer to the strategic asset allocation for the overall funds, wait and see what's going on. And then later during that week, we decided the risks are still significant and we want to trim a little to, instead of going to risk off a little bit.
So practically, you use your model recommendation exactly as such, as a recommendation. You need to think about what is going on in the world before you decide what to do with that. So you don't follow the model blindly.
In normal cases, we do. Yeah. And in extreme cases, like, the recent war, the COVID, our qualitative tool can guide us to override or reduce the overall trading size.
Okay, let's consider another example, April 2025. Liberation Day?
In April 2025, I have to tell you that the model was not in effect on April 2025. We were thinking about restarting to implement the model around April 2025. And because of the market volatility was too high, we decided to postpone to implement it, make it started in May 2025. The reason is that the pension fund decided to transact a pension risk transfer in early 2024, and there was a lot of liquidity was needed for that transaction. So from 2024 to April 2025, we just ran the model and we did not implement anything. The model was reintroduced in May 2025, and we were considered to implement in April, but given the huge volatility, we decided to postpone implementing it.
Interesting. I think this gives us some idea about how you think about risk. Can you elaborate on this?
We manage risk at two different levels. First is that in each asset classes, when we use the futures to implement plus and minus, long and short, we have a static limit for that asset class. We don't go beyond that unless we get the approval to doing so. And another risk measure is more dynamic. Basically, we measure this program's risk as a percentage of the total portfolio risk. The risk budget for this is no more than a third of the total active risk of the portfolio.
Okay. Is this all? Is this all how you think about risk? How about concentration risk, currency risk, model risk?
Concentration risk, because we executed through index level, it is the major index level. For example, we executed through U.S. large cap, small cap, emerging equity. It's all well diversified index. I do not trade individual securities. So that is the concentration risk is limited.
But concentration is not necessarily concentration in stocks or one sector. For example, we're not necessarily speaking about General Motors and Ford, right? It can be something different. It can be markets where correlations may all of a sudden go to one when you expect it least. How do you track that? How do you manage this kind of risk?
Yeah, that is actually the advantage of this program. This program is actually, we saw in many times when the market downturns, this provides a very good diversification. As we know that the benefit of diversification is always disappeared when you need it the most. However, with the factor models built in, this will provide the diversification exactly at the time that when we need it. That is the example I gave you in COVID 2000, when all the market comes down. This program generates very good positive returns, and that is the program. That is the problem, Igor. I think in managing the assets right now. If you think about the strategic asset allocation, you are constantly having long beta positions all the time. And the position will works well when the correlation are not one, they are, offset each other. However, when the correlation goes to one, when all the assets coming down, you need to have a program there help you to generate alpha at this particular time and to offset your risk at this particular time. And that is why I think that is the beauty of this program. It's more flexible. It's not you do not have to have the long beta all the time. And then they can offset those beta you have in your core portfolio so that it can protect the overall portfolio and provide resilience.
Okay. How do you think about geopolitical risk?
Geopolitical risk is not considered in this program at all. It's more of a macro risk that I think we have to use our qualitative process to assess that. And in general, I think the geopolitical risk is transitory. The long-term fundamental factors like the earnings power, the profitability, and where we are in the PE ratio, those are the ultimate factor that will decide where the market will go in the long run. I don't know what is your view on that.
My view is different. Actually, right now we are about to publish a paper in the Journal of Portfolio Management exactly on this topic, and our view is very different from what you have just explained. But your view also has the right to exist. After all, differences in views create opportunities in the market, right?
Yeah.
Let's speak about another kind of risk. You are, as a fund, not necessarily in your overlay program, but as a fund, you are long stocks, right? It can't be it can't work in any other way. So being long stocks, you are probably long cap-weighted indices, and being long cap-weighted indices, you are long AI. Big day. So how do you think about this? What if AI is a bubble? Do you think it's a bubble?
That is $1 billion question.
Probably even more.
Yeah, I know, $1 trillion, baby. I don't think I have a good answer on that. I'm still studying, and definitely we saw some impact from the AI to the SaaS companies, give investors a pause in early part of this year to adjust their valuation way down. And I think it is still playing out right now. And AI, it is a big booster for profitability for sure. And that has to be the way to go. That is for sure. But when it plays out, the winners and losers, how will determine that? I'm not in the way of making an individual stock call who will be the winner or losers for that. But I don't think I'm in a position to give you that good answer. However, back on the cap-weighted index itself, if you think that that index itself, it is a momentum-driven index for equity in indices.
Of course.
And that already have this momentum factor built in. And yeah, it is concentrated, but it also represents the aggregated view of future growth, future profitabilities. So it's hard to stay away from that.
Okay, so basically you're saying that if it's a bubble, you will ride this market all the way up. When it falls, you will take the hit, and nevertheless, you don't want to miss the opportunity.
When it falls, I do not. I mean, as long as you have the long-short market flexibility, you do not have to ride that wave down. You can also have the possibility to underweight or short the market and get profit from that way as well.
This is what you can do in your overlay program,
Yeah.
but you can't do that in your strategic asset allocation, right?
Mm-hmm. Yes.
If you're sticking to S&P 500 there, well, S&P will be falling.
Yes. You can basically adjust your beta. If there is a persistent market downturn, you can either, lower your weights, underweight the market, or short the market. That's how you can implement your risk management.
Okay. How do you think about portfolio construction?
Portfolio construction is a very important part of the return generation and alpha-driven because the way I think that the market is evolving over time, and how you want to take your exposure on a risk-adjusted basis, that's basically how this GTAA model was built on. we want to, build on a more risk awareness, more growth, more momentum, awareness portfolio. And within each asset class, I think portfolio construction also take a very, very important role. I'll give you an example. So, for example, in the our high yield market, there are three buckets we can take exposure: the regular high yield, and the BSL market, bank loans, and also private credit. And then those valuations and the dynamics are not always the same. For 5 years ago, I seen a lot of tailwinds on the private credit when the SVB went down. There's a lot of regional banks shut their doors to small business owners, and the Fed is on its track to hike interest rate. And as we know, the private credit is two component of the yield. One is the base rate, which is SOFR. The other one is spread. At that time, basically, you have a lender's market. You can determine whatever the documentation you want, and higher spread, and you're on a higher base rate as well. So definitely that is a better market. And at that time, I led the expansion into private credit. Fast forward to now, some of the dynamics of the tailwinds are disappearing, especially before the war. The central banks were on an easing path until the war happened. And then the BSL market came back, and too much money flow into private credit. So the dynamic is changing all the time. So I think the portfolio construction play a very important role to be aware of not only the market itself, but the macro, the trend. All this can help allocators to play a more important role in terms of generating alpha on a risk-adjusted basis.
Okay, let's talk about constraints. What constraints that you have are most significant for your portfolio, be it let's say position constraints or liquidity or regulatory or governance constraints, environmental, political, whatever?
Are you talking about the broader pension fund, not
Yes.
only the broader pension fund? From my experience, is liquidity. Liquidity is so important, and it is never there when you need it. And liquidity is a key role for us to be able to either, you don't have to fire sell your assets, or you can use this liquidity to take advantage of the market opportunities that presented to you. So I feel like liquidity is, and always, not paying enough attention.
Okay, this is interesting. Are there any constraints that are not written down but are always binding in practice?
I think we have a good risk management put into place, and when we manage, when I manage this portfolio, I'm very risk aware. I actually think risk management is one of the key component in running this portfolio successfully. And talk about limitation, I feel like, the current GTAA program is based on only the liquid assets. But if you look at illiquid assets, if you can incorporate the real estate, private equity, private credit into this program, that will be even better, because of course, it will introduce a lot of difficulty in terms of how you rotate it. But if you can incorporate that, and the risk for the illiquid assets are even larger and harder to manage. But if you incorporate those parts into the overall portfolio management, I think that will be even better. The portfolio can have a better result. Instead of just, a lot of the funds you can find out there just very siloed the public and private, there are different departments, different people managing this. And then each department has their own budget. You just fill that budget, fill that box. Instead of doing that, I feel like it should have a total portfolio perspective, one asset versus the other at the same level of risk, which one is more attractive, and then let the capital goes to the most efficient place. And then that is a better way to manage the overall portfolio.
Okay, that's interesting. Do you think about robust portfolio construction on the fund level? What are the principles of portfolio construction apart from those that you have just explained?
I think the principles is coming out from what is the goal of the portfolio. So different pool of money, they have different goals. For example, for the pension fund, it is manage the liability. So manage that liability and make sure the surplus wall is functioning within the limit. That is very important. And plus, liquidity is always important for everything. And the example for 401k plan, the savings plan, is different. The 401k goal is to have all the retirees to receive certain money so that they can retire at certain age. The goal for that is I want to have a cumulative returns, and at the end of the investment period, the range of the outcome of that investment become higher enough and tighter enough. I do not want to have a huge distribution. I want to have a very tight distribution. So I'm pretty certain that at the end of the investment day, the terminal value will be as within a certain range.
Okay. If we now go back to your overlay program, do you need to explain your positions or your process to the board?
Yeah.
And if yes, how do you do that? And does it get more difficult when you lose money?
Yes. That is not, that probably I should go back to the process itself. The process, starting from the quantitative models, those are tested for many years and tested for efficiency and robustness. And then I have the model signals, and then with those signals, I go through the qualitative assessment and make a trade recommendation to the EC, Executive Committee. And in that committee, we have a discussion about the overall risk tolerance we have, about the potential risk we need to think about, the relative attractiveness, and then the trading size. That will get final approval after the discussion. And then that will be executed externally. And then, so that is on the execution process. And on the board meeting, when we have the, especially lose money, that's definitely will have a hard time, and we'll explain what are the thinking process, why we lose money, and also always with a background that there is a market cycle. You can't making money all the time. And then market go through cycles, and we have some evidence that, we will continue this program, and then the program can turn around.
You mentioned that you execute externally. How do you think about the implementation risk, the execution risk? After all, you are a $50 billion fund. When you trade, you can move the markets.
Please bear in mind that the trades is put on the $10 billion. The general trade size is hundreds of millions, so it's not going to impact the market. And it's mostly through very liquid derivatives, futures, CDX. So those have very limited market impact.
Okay, interesting. If we think about your overlay program, What do you think is the biggest misconception that people have, especially pension funds have, about overlays in general and global tactical asset allocation in particular?
The big concept would be, oh, you cannot time the market. I
Can
heard it
you?
all the time. But if you think about this, no matter you talk about timing or relative value, all the asset managers and hedge funds, all the participants, they are doing something. Not doing something is also an active bet. So you either have an active approach from relative value, valuation, all those basic fundamentals, you come up with a systematic way, or you are just betting the market without awareness.
For you personally, throughout your investment career, what has been the biggest mistake?
In 2016, I think it's 2016, when we have a China scare, the global economy.
2015, August, I think.
Okay, a better memory than I am. And at that time, the global market slowed down, and we saw the earnings has a downward pressure, sentiment was down, and then we decided to underweight the market, risk off. And shortly after that, there's a number of central banks come out to support the market, and market take off very quickly. And that is the time I lost money, and that is the time that I started to learn that the market can turn around very, very fast. And underweighting or short the market is very risky. And we do that in the future very, very carefully.
Wasn't the same the case in March 2020? You said that you went into March with a short position in your overlay, but the market reversed very quickly. As far as I remember, there was a minus 10% day followed by a plus 10% day.
Yeah. That was, that's the same thing happened. And then it's always, the model cannot pick up that inflection point. It's always slow. That is for sure. And we are not expected to pick that lowest bottom point and then catch up the uptrend. I can never do that. But even though, we capture the market trend later on, that is still very helpful.
So in that case, in March 2020, you were able to reverse your short position reasonably timely. Of course, not at the bottom of the market. Nobody expects this from you, of course.
Right.
But quite quickly after the central bank started printing money and it became clear that the market was going to skyrocket.
Yeah, right. Always catch it later. On the downturn and upturn, always later. Not possible to capture exactly the same time. That's for sure.
Okay, Joy, thank you very much. This has been fascinating, very interesting discussion, and I'm sure that people will be interested to learn about how big pension funds are actually managed and what role overlays play in this management. Thank you.
Thank you, Igor. I really appreciate it. Thank you.